now, somewhere in Australia, someone is staring at a $0 bank balance the day before payday. They're not lazy, they're not careless, they're just stuck at the beginning, with no map and no real idea how far they need to go, and right now, someone else just quietly crossed $1 million net worth. They didn't win the lottery, they didn't inherit it, they just figured out the stages and moved through them one at a time. Today we're walking through every stage of wealth in Australia. From absolutely nothing to 7 figures, what each stage actually feels like, what's holding most people back at each one, and exactly what needs to happen to move forward. These aren't theoretical numbers, this is what the data shows. This is what the journey actually looks like. Let's start at the beginning. Zero net worth doesn't mean you have nothing in your bank account. It means everything you own is cancelled out by everything you owe. A car worth $15,000 with an $18,000 loan sitting behind it. A savings account with $2,000 and a credit card carrying $3,500. Millions of Australians are right here. Total household debt in Australia now sits at record levels, and even stripping out mortgages, consumer debt alone is dragging millions of people below zero on paper. At this stage, the most dangerous thing isn't the debt itself. It's the feeling that you're already too far behind to even bother starting. That's the lie that keeps people here far longer than they need to be. The move at zero is simple. Stop adding to the hole. Cut 1 subscription. Cook at home 3 more nights a week. You don't need a perfect budget right now. You need to stop the bleeding first. Everything else comes after that. This sounds embarrassingly small, but reaching $1,000 in genuine untouched savings, not your rent money sitting there temporarily, is a bigger psychological shift than most people ever give it credit for. That $1,000 is the difference between a blown tire destroying your entire month and a blown tire being mildly annoying. It breaks the cycle of reactive living, the cycle where every unexpected bill sends you straight back to the credit card, where every small emergency resets your progress entirely to zero. Research consistently shows that people with even a modest financial buffer make better long-term money decisions. Because when you're operating from desperation, you make desperate choices. You take the payday loan, you dip into super early, you avoid looking at your account because the number is too painful, get $1,000 sitting still, treat it as untouchable, then build from there. $10,000 changes the entire tone of your financial life. At this point, you've got roughly 3 to 4 months of basic living expenses covered if something goes seriously wrong. That's a real emergency fund. That's actual breathing room, and it fundamentally changes the decisions you're able to make. But here's something most people get wrong at this stage. Holding $10,000 in savings while carrying high-interest credit card debt is actually costing you money. Credit card debt at 20% interest is a guaranteed 20% return the moment you wipe it out. No ASX index fund reliably beats that. So if you reach $10,000 with bad debt still on the books, pay it off first, then rebuild your buffer, then start investing. Once the high-interest debt is gone, $10,000 becomes a genuine launchpad. It's your first meaningful investment into a diversified index fund. It's the seed that compound interest can actually work with over time. The Australians who stay stuck at this level are almost always the ones who let lifestyle creep eat the buffer. The moment they build it, they hit $10,000 and suddenly decide they've earned a holiday. They deserve the upgrade, and then they're sitting at $2,500 wondering how they got back here. $25,000 invested in a diversified ASX 200 index fund, compounding at 9% per year, grows to roughly $59,000 in 10 years. Without adding another cent, that's the moment investing stops being theoretical and starts feeling real. At $25,000, you also start looking at your superannuation differently. The average Australian in their early 30s has somewhere between $30,000 and $55,000 in super depending on their employment history. Sitting alongside a personal investment portfolio, you're starting to build something that genuinely shows up on a balance sheet. The trap at this stage is impatience. People feel behind. They start reaching for higher returns. They shift from diversified index funds into individual stocks. They get into speculative assets because someone they know made 40% last year, and they hand back everything the compound interest quietly built. Boring wins here. Consistently, reliably, stubbornly, boring wins every time. Nobody talks about $50,000 the way they talk about six figures. But this is the stage where compounding starts to feel tangible. $50,000 growing at 9% earns you $4,500 in the first year alone. Completely passively, that's close to $87 every single week your money is generating without you doing a thing. At this stage, many Australians start seriously considering property for the first time. And that's where it gets complicated fast. $50,000 is not enough to buy into Sydney or Melbourne at current median prices. But in regional growth corridors and outer suburban markets, it gets you into the conversation. Particularly with the first home guarantee scheme still accessible, where eligible buyers can enter the market with as little as a 5% deposit without triggering lenders' mortgage insurance. The critical question at $50,000 is direction. Do you want liquidity and compounding through shares, or leverage and forced savings through property? Neither answer is universally right, but drifting without a clear strategy at this stage costs years. Sitting in cash waiting for certainty that never comes costs decades. Six figures. The number every Australian seems to be chasing. And here's the truth. Crossing $100,000 in investable net worth is genuinely significant. You are now ahead of roughly half of all Australian adults when it comes to wealth held outside superannuation. But here is what nobody tells you. The first $100,000 is the hardest part of the entire journey. Every dollar after it gets measurably easier. At 9% returns, $100,000 earns $9,000 in year one. That's more than many Australians manage to save from their salary in the same 12 months. Your money is now working harder than you are. This is also the stage where tax strategy starts to genuinely matter. Once your investment income becomes meaningful, tools like salary sacrificing additional contributions into super, exploring investment bonds, or understanding the implications of your portfolio structure start delivering real returns. Getting proper financial advice at this point isn't a cost. It's one of the best investments you can make. The most common mistake at $100,000 is the lifestyle upgrade. You worked hard, you sacrificed, and now the voice in your head says you deserve to reward yourself. Maybe you do, but doubling your spending right here delays the next milestone by years, and most people never fully recover the momentum they give up at this stage. At $250,000, the numbers become genuinely hard to ignore. $250,000 compounding at 9% generates $22,500 in a single year. Passively, without you touching it. That is more than the Australian age pension pays annually. Your portfolio is producing pension-level income entirely on its own. At this stage, most serious wealth builders are also looking at property alongside their share portfolio. Not necessarily because property outperforms shares on paper, but because leverage rewrites the maths completely. Using $250,000 as equity combined with a bank loan to control a $750,000 growth asset means you're capturing growth on 3 times your actual capital. Run both engines together and wealth compounds at a rate that feels almost uncomfortable. The Australians who break through $250,000 almost always share the same pattern. They kept their lifestyle flat while their income grew. They stayed in the same apartment 1 extra year. They drove the same car for 3 more years than felt comfortable. And every dollar of the gap between income and spending went straight into assets. $500,000 is a fundamentally different conversation. Applying the 4% safe withdrawal rule, $500,000 generates $20,000 a year indefinitely without touching the principal. That won't fully replace a working income, but combined with superannuation, rental income, or reduced hours, it starts painting a picture of genuine choice. At this stage, time becomes the real asset. Not just compound time, actual lifetime. Decisions start getting made based on what you want rather than what you can afford. People start taking the lower stress role. Working fewer days. Saying no to projects they hate regardless of the money on offer. The biggest risk at $500,000 is fear. A lot of people reach this number and shift everything into cash or term deposits because they can't face the idea of losing it. Completely understandable. But with inflation running at 3%, $500,000 sitting in cash loses roughly $15,000 in real purchasing power every single year. Protecting your number isn't the same as protecting your wealth. Stay invested. Stay consistent. Keep going. $1 million. Roughly 7% of Australian adults hold $1 million or more in net assets outside their primary residence. It is genuinely rare. It is absolutely achievable. And it takes longer than people expect, but less time than they fear. At 9% annual returns, $1 million generates $90,000 a year in passive income. That is above the median Australian full-time salary. Entirely passive, every single year, without clocking in once. Paired with a superannuation balance, where someone in their early 60s with a consistent work history might hold $300,000 to $600,000. $1 million investment portfolio puts real financial independence within reach. But here is the thing about the $1 million milestone that most people get completely wrong. It doesn't feel the way you imagined it would. There's no moment of arrival, no fanfare. It's a Tuesday. You check your portfolio. The number has 7 digits. And then you go make a coffee. Because by the time you get here, the habit became the point long before the number caught up. Here is what the journey from $0 to $1 million actually teaches you. The stages are not really about the money. They're about the decisions you make when the money gets uncomfortable. When $10,000 is begging to become a holiday. When $100,000 is quietly suggesting you deserve a better life right now. When $250,000 finally feels like enough to relax. Every stage has a trap, and at every stage that trap looks exactly like a reward. The Australians who build generational wealth are almost never the highest earners in the room. They are the ones who kept the gap between what they earned and what they spent wide open, and fed that gap into assets consistently, through every single stage, until time and compound interest did the rest. Wherever you are on this scale right now, $0, $10,000, or halfway to 7 figures, the move is the same. Protect the gap, feed the assets, let it run. If this gave you a clearer picture of where you are and what comes next, subscribe to the channel and turn on notifications. Thanks for watching, and I'll see you in the next one.